Hello. Okay, I'm recording this video, and this video is about the chapter 16 of the corporate finance course. Since I'm looking at a camera and talking to a camera, it's a little bit weird, but I'll try my best to do this right. Um, so this is chapter 16 of the corporate finance. It's about financial leverage and capital structure policy. So this chapter has two parts. The first part is about the effects of the leverage, that the leverage can amplify or increase the range of your EPS, of your profitability. So the second part is about a bunch of calculations that could be emphasized in the exam, because the exam is has a lot of calculation things. So the 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 second part is about the Modigliani-Miller theory, and under two cases, and the second case has two propositions. So let's talk about the first part now. The first part is, I'll just go through the slides for the first part because the slide is quite clear. So we the first part is about the capital structure. When we talk about the capital structure of the corporation, it's mainly about the debt equity ratio. So the company can finance itself through two channels: borrow money, or ask the other investors to be the stockholder. Okay. For the first one, they give you money. For example, I'm a firm that other people give me money. The debt issuer. No, I'm a debt issuer, and they're the debt buyer. So the debt buyer will give me the money in exchange for the debt that I issue to him as a certificate, so that they can ask me for the money, the principal plus interest in the future. So for this money, I get it. I need to repay it plus the interest. Okay, this is debt. And for the equity, it is the money that I ask them to put into my company, while I give some of my shares or the treasury shares of the company to this person. So that investor could be the stockholder. So he probably has like 20 to 30% of the company stocks. So in the future, or maybe even more. So in the future, if the company has make profits, we give the appropriate proportion of the profits to them. If we sell this company in the future, then he got to 20 to 30% of all the money of that we gain from the sales. So the debt to equity, debt and equity are the two ways for the firms to finance themselves. So here we have a question: why do we borrow money? What is the advantage of borrowing money instead of having the stock equity investors? So the the very straightforward question is, what is the proportion of the money being raised by debt, and what is the rest of the capital in the firm being raised by issuing equities? So the debt equity ratio is called the capital structure. Okay, it's usually calculated as debt, the value of liabilities divided by the value of equities. Um, so the debt restructuring, just like what's this term indicates, it's about how to change the debt equity ratio. It's about it involves changing the amount of equity leverage a firm has without changing the firm's assets. The firm can increase. Let me first check whether I'm really recording it. I'm not really sure. I hope it's. I think I'm recording it, right? Yes, I am. Although it doesn't really show, but I believe I'm recording it. Otherwise, I'll just talk for 1 hour for nothing. the capital restructuring involves changing the amount of leverage a firm has without changing the firm's assets. Thus, if you have like $100 million assets, previously your debt was $50 million, your equity was $50 million. Now you change it to 60 to 40 or 40 to 60. So the total assets equaling leverage plus equity will not change. The firms can increase the leverage by issuing debt and repurchase the outstanding shares. I borrow more money from someone else, or the original debt buyer. Then I use extra money to talk with equity holder. Say, hey, how about you just sell your previously owned equity to the firm again, and we'll just give the money to you. Or the firm can decrease the leverage by issuing new shares and retiring the outstanding debt. And then the question is how to choose a capital structure, and what is the primary goal of financial managers. In any Anglo-Saxon culture textbooks, it's about maximizing the stockholder wealth. Although I do not personally fully agree with this, but this is how the textbook writes about it. And this is also what when you write even academic papers or you take the exam, you should just remember this. This is like a guideline. You maximize the stockholder rather than stakeholder wealth. Anyway, so we want to choose a capital structure that will maximize the stockholder wealth. And we can maximize the stockholder wealth by maximizing the value of the firm or minimizing the WACC, weighted average cost of capital, which is covered in the previous chapters. This is not very difficult. So basically you have the weight of each, like the debt, equity, and preferred equity. Then you calculate the return. Return is from the debt or the equity holder. This is a return to you, but from the position of the issuer, this is its cost. So the return is also the cost. You want to minimize for the firm, which is the issuer of the debt and the equity. You want to minimize the average return or the average cost of capital. So what is the effect of the leverage? How does the leverage affect EPS and ROE? So earnings per share is calculated by the net income divided by the number of shares, and ROE, which is the net income divided by the equity value of the firm. So when we increase the amount of debt financing, we increase the fixed interest expense. Okay, if we have a good year, then we pay our fixed costs, then we have more left over for our stockholders. If we have a bad year, we still have to pay the fixed cost, and we have less left over for our stakeholder. So leverage amplifies the valuation in both EPS and ROE. And also, there were some taxes that could affect our calculation and way of thinking. So we first ignore this in the first part of this chapter, and we will also ignore this at the first part of the second part. And the first case of the second part, then we will go back to this in the second case of the second part. So we assume that there is no tax here. So what will happen to the EPS and ROE when we issue debt and buy back shares of stocks? Let's take a very simple example. For example, these numbers are made up, so you don't have to question where we got this. I just copy, I just typed everything in the textbook and to the Excel, and just made a copy here. This is so. For example, you have like two capital structure. One is the current one, where all of the assets are raised by the equity, and the proposed one, you have half of your assets raised by debt and half of the assets raised by equity. So in the first one, your debt equity ratio is obviously 0 because you have no debts. So the share price will be $10 because you have 5 million equity value, and you also have 5 million outstanding shares. This is a share number. Okay. In the proposed structure, because you issue less shares, you only have like 250,000 shares, so the share price is also $10, and your equity value is half of the equity value of the current capital structure, which is $2.5 million. So let's take a look at the ROE and EPS under different economic scenarios, under each of the two capital structures. First, let's take a look at the current capital structure in which we have no debts. So in the recession period, we have the EBIT of these $300,000, and in the expected, which is the normal economic situation, we have $650,000, and for the under the economic expansion, we have $1 million dollars. So these don't question where we get these numbers. These numbers are made up. Okay, we just assume this. So we under this capital structure, because we have no debt, we have no interest expense. Therefore, the interest expense is zero, and the net income will be just the EBIT. EBIT, I hope you still remember, it's the earnings before interest and the expenses, and I'm sorry, and taxes. This is from the income statement. So the ROE will be net income, this one, divided by the equity value, by this value. Okay. So this divided by 1 million divided by 5 million will be 20%, and 300,000 divided by 5 million will be 6%. And the EPS will be net income here divided by the number of shares here, number of shares. So it's 300,000 divided by 500,000, and this will be 1 million divided by 500,000, which is 2. In the proposed capital structure, where your debt is $2.5 million, and we get the same EBIT under 3 economic situations, but now the different thing is that we have the interest expense. The interest expense is from the fact that we borrow money now under this proposed capital structure. So we assume that the interest rate is 10%. This is 10% here. So I just want to make sure that I'm really recording this. Where was I? Okay. So this is earnings before interest and taxes. Here we assume that taxes is 0. So net income will be just EBIT minus interest. 300,000 minus 250,000 will be 50,000. And for the expansion, 1 million minus 250,000 will be 750,000. Okay, as you can see, and you can also calculate the ROE and EPS by dividing the equity value here and outstanding number of shares here. So 50 divided by 2.5 million will be this, 2%. And the 50,000 divided by 250,000 will be 20 cents. Okay. So you can see that the range of ROE is enlarged from 6% to 20% under the current capital structure with no debt, to 2% to 30% under the proposed capital structure where we have a debt of $2.5 million. And so we have the range goes wider. The range goes wider. So the variability in both ROE and EPS increases when financial leverage is increased. And it's better to see this from the textbook, where the EBIT is going up under the proposed capital structure with debt. You will see that the slope is steeper. Okay, the EPS goes up even faster when EBIT goes up. also the EPS goes down even faster when EBIT goes lower. Well, when we have no debt, the slope is less steep, so the EPS will go up and down slower relative to the when EBIT goes up or down. The break-even EBIT is the EBIT that makes EPS under both capital structures, the same. So this is this point. How do we calculate this? It's easy. We just find out the under no debt, then there was no interest expense. It will be just the EBIT minus 0. Okay, since taxes is also assumed to be 0, then it's going to be EBIT divided by the number of shares. It's going to be 500,000. Under the capital structure, the proposed capital structure with the debt and of 2.5 million and also the interest expense, we know that the interest expense is 250,000. This is calculated by the interest rate 10% times the 2.5 million, and the number of shares is 250,000. The first 250,000 is from this times this, which is the interest expense. The second one, this 250,000 is from here. It's the shares outstanding. Okay, this is the EPS. And solving this equation is pretty easy. Then you just find out that the EBIT should be 500,000. The break-even EBIT should be 500,000, and your EPS will be calculated either from this side or this side. You will find that the EPS will be $1. Okay. So the conclusion is that when EBIT is relatively high, then the leverage is beneficial. When your EBIT is low, of course, your leverage is not beneficial. For example, it's just like you borrow money to trade futures. Well, if you ever trade the futures, you know the futures have a lot of very high leverage. So if you have leverage, then when you lose money, you lose a lot of money. Well, when you profit, you also profit a lot. Okay. Under the expected scenario, leverage increases the return to the shareholders because under the expected scenario, your net profit is positive. So if it's negative, then leverage decreases your negative return even more. Okay. Well, when you have the more debt under the proposed capital structure, of course, the shareholders are exposed to more risk. Okay, so there was a tendency to make you to have you make another conclusion that because the impact of the financial leverage has both have the effect on both expected return to shareholders and the riskiness of the stocks, capital structure is an important consideration. In reality, so this is very confusing part. In reality, yes, this one is right, but theoretically it is wrong. It is wrong under this model, under the current model of this. So in this model, we assume that there is no tax, which is very unrealistic. And we assume that there is no bankruptcy risk, and we assume this is a fully competitive market with a lot of assumptions. So under these model with a lot of unrealistic assumptions, this is incorrect. This is called theory, the Modigliani and Miller theory. So under this theory, saying that so this is a good framework to let us understand why capital structure matters, because we know that under some assumptions that then capital structure doesn't matter. It doesn't matter because you can always use homemade leverage. That is, like I think you can ignore this, but or you just read the textbook for this one. So the basic idea is that now for the firm to borrow money, okay, I borrow like in this proposed capital structure, I borrow half of the assets that I need from debt. Then I ask the investor to give like half of the assets I need. So why is this essentially the same as this for that investor? Because for the investor, I can just make a homemade leverage. That is, it's not the firm borrowing money; it's just the investor borrowing money. For example, I borrow money from our other professor who's pretty rich. Like I just say, hey, how about just give me like $2.5 million? And they say, well, it's not a lot of money. I give you $2.5 million. So I will pay him the interest, and I get this $2.5 million with original $2.5 million with my originally owned $2.5 million. So I can buy all of the equity of this under this current structure. So for the shareholder, it's the same. Okay, like I still have the risk for the firm owner, like the firm. So it's essentially the same, and you can find that the EPS, no, the net earnings will be the same. Okay, so this is the idea of the homemade leverage. But this idea, of course, is wrong. For example, I mean, it is right in this model, but it is wrong in reality. For example, for you to borrow money, your interest for an individual to borrow money, your interest rate that the bank gives you will be highly likely higher than the firm. For example, the large firm, the listed firm in the stock exchange to borrow money. So your interest rate could be different. Okay, and for example, if you yourself borrow money, if you cannot repay, it's an unlimited liability. You should spend the rest of your life to repay the debt. For the firm, especially for the corporations with limited liability, if they just claim bankruptcy, then they don't have to repay. They don't have to repay the money that they owe, and as which they still owe. So, but here, since in this model we assume no taxes, and also the taxes could be different from for the individuals and the corporations. But since in this very simplistic, unrealistic model, we assume there is no tax, we assume there is no bankruptcy cost, then the homemade leverage could be the same as corporate leverage. Okay, so this is the first part of the slides. Then we go to the second part. Well, this is quick because I'm just talking with the camera. We don't have questions. So we will skip this and focus on the case 1 and case 2 of the capital structure theory under the special cases. In the first case, we assume there is no taxes, but in the second case, we assume there is tax. There is a tax rate. In the first case, we have the proposition 1 and 2. The value of the firm is not affected by the change of the capital structure, and the cash flows of the firm do not change. Therefore, the values do not change. The proposition 2 is that the WACC, the weighted average cost of capital of the firm, is not affected by the capital structure. Okay. I will first go over this slide, then we will go to my notes, because I think my notes are clearer, easier to understand than this slide. This is my personal opinion. Probably you think like the textbook and this slide is clearer. So it totally depends on you. Know that WACC is this is a return of the total assets. Okay, and we have the assets. The assets have two components: equity and debt. So the average cost of capital, the average return or the cost of capital of this whole company, all of the assets of this company, will be a weighted average. So this is the weight of equity in the whole firm value. So V is E plus D. D is a debt equity value. Okay, the weight of the equity times the return of the equity plus the weight of the debt times the return of the debt. Now we can just rearrange this formula. Then we can get the equities. This is basically ROE. Okay, ROE, return on equity. The ROE will be this. So the RA is the cost of the firm's business risk. That is operational risk. Well, here is the cost of the firm's, the second part of this equation is the cost of the firm's financial risk. When D is zero, when the debt is zero, then you don't have any financial risk. All of your risk is operational business risk. And when D is going up, then when D-E ratio is higher, then this risk is also higher. Is this risk better? Like beneficial to your ROE? Well, it depends on the relative comparison between RA and RD. RD is a cost that you borrow money. For example, at 8%, I borrow from, let's say 5%, you borrow from someone. But your firm's ROA, the return on assets, is 10%. It's higher than 5%. Then the leverage will be beneficial to the stockholders, to the ROE. If like you don't make a good money, for example, the restaurants and some industry in Hong Kong this year, in 2019, your ROA is you borrowed money and it's still 5%, but you only made like a profit of 2%. So you actually lose money. Although you make 2% profits, you still have to repay the interest. So that's 5%. So you lose money. When you lose money, the financial risk, the leverage increases your financial risk and make your ROE even lower than the case without debt. Okay. So this is an example. Basically, it gives you the ROA, RD, and DV. Ask you to calculate RE. So the only small trick is that you have to calculate the DE ratio from the DV ratio. It should be simple to you because V is just D plus E. Okay. Then we go to the second proposition. This is a little bit. I want to skip this slide and go to my notes because I think this is simpler. This is what I wrote for the last semester's course. I think this is more intuitive to understand. So let's first go to the case one. This is from the WACC is ROA is weighted average of the return to equity and the return to debt, which is the interest rate. Then you can rearrange this and you get the RE's equation. This is what we just talked about. And you also have the CAPM model, the capital assets pricing model from the RA. You see, like we use the CAPM model twice. The first time for RA, the second time for RE. So first we use the RA. Then this is equal to the risk-free rate plus the beta of A. Beta of A is the beta of the whole firm value. And this is the expected market return minus the risk-free rate. So from these two equations, you can replace the RA here with RA here. Okay, with all of this. So then you can get the RE equals the branch of this thing. You can just make the calculation by yourself. But you will get this. So it's going to be RF plus beta A times 1 plus DE. So it's going to be V divided by E, okay, because E plus D will be V, the firm value. And we also compare this one with compare model of ROE. So RE will be RF plus beta E times RM minus RF, because for whatever equity, whatever asset, your assets return should be risk-free rate plus your betas, your assets beta times this risk premium. So compare this two, you will find that if these two both hold, then RE should be beta A times 1 plus DE. This part is financial risk. This part is business risk. Okay, the beta A is business risk. If the DE is positive, it's always positive. It should be positive, right? In extreme cases, E could be negative. Like sometimes Yahoo, like there was some time like Yahoo's equity was negative because the not sure if this is market anomaly or anything, but already Yahoo holds the stocks of Alibaba, and the Yahoo's market capitalization minus the capitalization of the Alibaba stocks is equity value, which is negative. But this is an extreme case. So usually, like these two are both positive. So we know that RE will be greater than beta A. It will be equal to beta A when D is 0. Okay, when there is no debts. And for second one, so this is about the second case. The second case, case 2. So case 2. So case 2. This is case 2. So we have the unlevered firm and levered firm. Compared to the unlevered firm and levered firm, which firm's value will be higher? The right answer is the levered firm. You borrow money. Okay. Well, when you borrow money, you actually utilized the tax shield. We talked about this several times. When you borrow money, you pay the interest expense. So your taxable income is lower. And you save money from paying less taxes. So that is called tax shield. You shield it. You prevent it through the interest expense by paying less taxes. To pay less taxes. So the CFFA, we talked about this in the previous one. This cash flow from assets will be higher because you pay less taxes here. So the question is how much money you save from paying less taxes. Like how much less tax you have paid for. So the answer is this. Because I don't have the whiteboard, I cannot write it. If I were talking about this in the class, I would write it. So this is RD, is the interest rate. Okay, this is the amount of money that you borrowed. So this is the interest. D times RD is the interest. D times RD is the interest expense. Okay, and we talked about the tax shield before. The tax shield would be the interest expense times the taxes, the tax rate. Okay, the tax rate, because you have these interest payments, and the interest payment is deducted in the calculation of the taxable income. So since it's deducted, the interest expense times the taxes, this amount is deducted. So as a lever firm, the lever firm saved this money. You save this money every period. So let's go to my notes. It's like, this is a timeline model. You saved this amount in period 1. You save this amount in period 2, period 3, and you save this amount. If everything is constant, then in this model, you save this amount of money like always in the future, all the way to the future. So what is this? If you regard this, the saving of this as a asset, it's gonna be a cash flow. Then it is perpetuity. A perpetuity's present value, or the present value of the tax shield, will be the every the perpetuity's present value will be every period's cash flow divided by the interest rate, and the interest rate is just the RD, because we assume here that there is no bankruptcy risk. So the debt is risk free. So the risk free rate is the debt rate, okay, the interest rate. Therefore, the PV of the tax shield is DT. So what is the firm value of the levered firm? The firm value of the levered firm will be the unlevered firm's value plus this addition, DT. And what is unlevered firm's value? Because every period you pay your income, your cash inflow will be EBIT times 1 minus T. In case 2, we assume that there is a tax rate. Your every period's income will be this. So your unlevered firm's firm value will be this divided by RU. Remember that this is RU. RU is unlevered cost of capital, okay? It's different from the cost of capital. So this is unlevered firm. So when you know EBIT, when you know tax rate, when you know RU, you can calculate the unlevered firm's value. And you have the DT, you can calculate, you have the tax rate, you have the DTC and T should be the same. Okay, I just forgot to write a C here. You should have the VL, the levered firm's value. When you have the levered firm's value and you have the debt amount, you can calculate the E. You can calculate the equity value. Okay. When you have the equity value and D, you can calculate V, so you can calculate the both weights. When you calculate both weights, and you know this and this, and the ROA, then you can calculate the ROE. When you calculate ROE, you can put the ROE here and calculate the others. So let's take an example. Look at the example. The example is, so here is the same as what I said. So the PV, the present value of the tax shield is DT, okay, DT. And the unlevered firm value is per period income divided by RU. And the levered firm's value will be unlevered firm's value plus DT, the present value of the tax shield. And the E will be this minus D will be your equity. Okay. So in this example, we have the EBIT tax rate. So this is EBIT. This is TC. Okay. The tax rate, and this is D. This is RU. This is RD. So the U will be EBIT 25 million times 1 minus T divided by RU. Okay, so you got VU. Then you can calculate VL. VL is RU, okay, is 135.42 million plus 75 is D. So 75 is D times the tax rate. Then you can get the VL. And E will be the VL minus D. Okay, and you get the E. So when you get the E, you can plug E into this. And this is 86.67 is this. Okay, this is E, and 75 is D, and you have the tax rate, You have the RD, you have the RU. The both were given. RD, RU, both were given. Then you have the RU here. You can calculate the RE. When you calculate RE, you can plug the RE into this. You have the E calculated before. E calculate before, and you have the V, okay, V calculate here, and you have and it's also easy for you to calculate this one, this DE ratio. Is this a DE ratio? This is the DE ratio. This is DE ratio. This is the DE ratio. And wait, no, what? Yeah, this is a D ratio. This is a DV ratio. This is D divided by V, and this is E divided by V, and this is RE. RE is calculated here. Okay, from this one. So I don't know why the slides is like this. So we use this one to calculate this. RE. So RE is here. And we have RD. RD is 9%. I think it should be 0.09. Okay. I think it should be 9%. Okay, it is a typo. It should be 9%. And this is 1 minus T. So that you can calculate the RA equals 10.05 if the calculation is right. So this is the whole calculation. If you have this in the final exam, just calculate the following this. Okay. So the summary of the formulas for case 1 and case 2 are summarized here. Basically, it's everything that I just talked about. I hope that you find this slides very clear. All of the other side, this one will be a comprehensive one, but you can study it by yourself. Okay, thank you. This is chapter 16, Financial Average and Capital Structure Policy.